market consolidation and what causes this. And also, why do trades break out from these areas and regions on your charts? Hi guys, it's Bruce Banks here, and we're going to talk about market consolidation. Market consolidation is something that you will see constantly in trades and can provide a lot of opportunities and can cause a lot of problems for certain traders. So first off, what is market consolidation? Well, we have many examples of market consolidation when you open up your chart, and it's when the market decides to move sideways. It can be through high volume times, it can be through low volume times. Like you can see this happened during the trading day here. So we have this, some of this was during high volume times. We're on a 30-minute chart here. And it can happen during low volume times often it's more common because after hours trading is often a lot more sparse. So there's less of a push to move in certain directions. So what does it really mean when there is market consolidation? Well, during areas like this where there's market consolidation, we have an agreement of buyers and sellers on both the price and the value of whatever they're trading. That agreement on price and value is an important point because often price does not represent value in the market. When there's this agreement on price in the market, this is an area where many institutional traders are willing to trade. We'll zoom out here and we'll highlight like these areas that we're seeing here. The institutional traders, the big money people, people that overshadow, small traders like ourselves, this is where they're willing to trade. And why are they willing to trade there? Well, because in like these three areas we have outlined here, there is a high supply of both buyers and sellers in the market. And this high supply of both buyers and sellers in the market means that they can offload high volume positions quite easily. So they're able to get a more consistent price. Small traders do not affect the market. 10 contracts do not really affect the market on a greater scale. We're talking about institutional money managers here. These are people that are really able to affect the market. And the problem is, say if Joe Schmo trader decides that right here he wants to take a position. He wants to take a long position. He can do that. You can hit buy on your charts and you will get a position on this market. And similarly, if you choose, say, right here, you choose like halfway through this bar as it's rocketing up, you're like, I want to get into a position. I want to take a long on this trade. You can do that. You hit the buy and there will be a bit of slippage, but in the end, it'll be minor. You're only taking one contract. Thing is, as the market starts to rocket up, we get less liquidity in the market. That's what causes the market to move. There's not a great supply of either buyers or sellers, and the market starts to move between those areas. So we'll take a step back. In these three areas I have highlighted on this chart, this is market consolidation. There's a large amount of buyers and sellers in this market. So institutions are more willing to make transactions here. They can do large transactions because if they want to sell, they know there's a large amount of buyers in the market. If they want to buy, there's a large amount of sellers in the market. There's more of an agreement on price here. But then what you start to see happening is, well, markets trend. Markets move up, markets move down. Some of it's news caused and can be a whole host of other reasons. A lot of it can be to do with market psychology. But when the market starts to move, there's a bit of a problem for institutional traders and big money managers, is that when it moves out of these areas, it's not as easy for them to find an opposite side to the trade that they want to make. So when the market moves out, often it will range or it will move to another area until it can find an area of consolidation again, because that's where there's more that's where there's more availability of trades. Right now, we're just breaking down these high volume areas, these high liquidity areas where there's a lot of institutional money. So we can see this in even other points of this chart. See, we see a little bit of after hours consolidation here. We see another area of consolidation here, but we have to also look down and see the fact that this is after hours trading. So we can't take this as significant of an area as if there was high volume here, because even though the market is consolidating here, this is overnight. This is not during trading hours. So there's less volume in the market. Even though there is still trading, the amount of volume availability is just not there. So say a big institution wants to take a large amount of trades, either long or short here. If they start putting on trades, they can affect this market so heavily. So if they want to short the market, they start shorting the market. All of a sudden, there's this huge supply of shorts in the market. They just can't trade with the amount of volume that they are trading with in these areas. So this area of consolidation isn't as important as, say, an area of consolidation over here, where we see the market not moving very much even during a trading day. There's a lot of liquidity there for them to make whatever trades they want, if they want to hedge short or long, however they choose. So that's one benefit as an individual trader that you have. You don't have to worry about these consolidation areas being the only place where you can trade, because you can take trades almost anywhere on the chart, unless we're getting a very, very sharp move for, news related. We're getting a massive drop, or there's just a massive sell off or a massive buy up of a stock, forex, cross, or futures contract. As an individual trader, you can take advantage of these breakouts until the market has broken these levels, and then looking for other areas of consolidation where big institutional money will come back into play. I can't wait to dive down in another video about market profile specifically and how it can help identify areas of consolidation in the market with large volumes of trading.